Are you ready to buy a home but not quite sure where to start? The home buying experience can be a little overwhelming, but with the right knowledge and preparation, you can make your dream home a reality. Today, we interviewed one of our top local lenders to give you inside tips on how to secure the best financing options. Whether you're a first-time buyer or you just need a little refresher, this is the video for you. If this is your first time to our channel, don't forget to subscribe and hit the bell icon for notifications. We're here to guide you through every step of buying, selling, and living in Western Washington. From expert advice to practical tips, we've got everything you need to make informed decisions. So join our community today and start your home buying journey with confidence. I'm Brandy, and together with my husband and partner, William, we are the WB Noble's real estate team. We love what we do, whether it's exploring the stunning neighborhoods of Western Washington or helping you find that perfect place to call home. Whether your move is just around the corner or a bit more on the horizon, we're here to guide you every step of the way. All our contact information is in the description box below, so don't hesitate to reach out. We can't wait to help you discover the best of what Western Washington has to offer. Now, let's dive into the conversation with Larry. There's some really good juicy bits in there, and I'm really excited to share this with you. I'd like to welcome Larry the Lender. Larry, can you tell us a little bit about yourself?
Sure, yeah. My name is Larry Dodson. I've been in Washington or the Puyallup area for a long time. Let's just put it that way.
Okay.
I have been doing lending since about 2012, and I never occurred to me about doing mortgage lending or helping people with the loans on homes that they purchase. But I was actually recruited into this industry. First time I'd ever not had a job, a friend of mine came to me. He was in the mortgage industry and was telling me about it. Asked me to go to breakfast and started chatting about it. I walked away thinking, what? No, I'm not doing anything like that. What does that even entail? You know, and I thought,
what does it even mean?
Yeah, so I thought, why not? He called me and told me, he goes, you would be great for this industry because number one, we need ethical people in the industry. And he said, you were kind of like the little mayor of Puyallup. Everybody knows you. You have a good reputation.
Love that.
And that's how you get started and how you can be successful in this industry. But not only for me to be successful or to help a company be successful, but for people to have a successful closing to get really that thing that they want, and that is that home that they want or the loan package that they want.
Yeah.
So I've always given 100% with whatever I've done. I've sold everything from soup to nuts, everything from coaching, Little League baseball, basketball. I've helped with wrestling. This is just another way of teaching people how to be successful in one of the biggest purchases that they're going to ever make.
Yeah. I love that because that's one of the reasons why William and I do this together, because we love helping people, plain and simple. So it's really beautiful. I love that connection. We would like to start off talking about budgets and the importance of understanding your budget as a buyer.
I think that's a big question I think people need to ask themselves. Number one, there's something that's out there that's called house poor. And me personally would never want to set somebody up to where they get this thing that they want, this home, however they can't live their life now.
Yeah.
Unfortunately, real estate taxes will probably continue to rise. So we need to try to set people up successfully where there's a spread in between there so they can still buy athletic gear for their kids that are going through junior high and high school or select sports, whatever it may be, so that they could be successful in whatever their journey is through life. So when they set up a budget, there are guidelines that have to be followed anyway. You can't even be approved for a loan to where there's some sort of huge debt on there that would if there was a huge debt on there, it would preclude them from being qualified to buy a home anyway. So there are qualifiable steps there. It doesn't necessarily mean that they should take it to the limit. So when I speak with people, I really have a one-on-one kind of a coaching and question and answer session on what the most important things are to people to keep their budget in check.
Yeah.
I don't know if that answers that question very well.
That does answer it, and I'm really glad that you touched on real estate taxes going up. Because, for example, my parents, they built their retirement home, and they planned for this and planned to be there until they're done, and all of a sudden their real estate taxes are going up to a point where it's scary for them because they're not sure how much longer they're going to be able to afford living in that home.
Right.
So I think that's a super important factor to think about, and it's not something that I originally thought about when we were.
Well, here's a very important piece of that real estate tax, in my opinion. A lot of this might be my opinion, but that should not also deter people from buying a home. And here's the reason why. Say somebody's like, well, gosh, I don't want to buy a home because, my real estate taxes are going up. If you just grab that one piece that we spoke about, you have to think of the whole picture. Being that if you're going to be a renter now for the rest of your life, the home that you're renting, those real estate taxes are also going up. And I can tell you, if the real estate taxes are going up, so are your rent's going to go up, right?
Yeah.
So instead of creating wealth for somebody else, even though those real estate taxes may go up, create wealth for yourself. And there's a lot of people that don't realize that they could be doing that at this point.
Yes.
So
thank you for that distinction. Yes, definitely create wealth for yourself, and keep in mind that those rates will go up, and plan accordingly. Finding that balance, right? We're always trying to find that balance. Can you talk to us about debt to income ratio?
Yes. So debt to income ratio obviously is a very important calculation, even for qualifying, based on different programs. That number is different for each program, and I still get people that call me today, how do you calculate debt to income?
Yeah. Let's
not overthink this. Let's make it really easy. Debt versus your income. That's it. Okay. So if you have $500 of debt every single month, right? Which is inclusive of 2 credit cards and a car payment, let's say, because you don't have a house payment at this point.
Right. They're not going to use your house payment.
They will use your house payment in the qualification.
Okay.
So let's just say your current debt to income ratio.
Okay.
Okay. So let's say that's $500. That was the number I used.
Okay.
And let's say your income is $1,000 a month. Your debt to income ratio would be 50%.
Right.
Because that's 50% of the income that you have.
Okay.
Okay. Now, when it comes to qualifying for a home, there are debt to income ratios that are guideline specific. Okay. So I always use kind of a rule of thumb 50%. So if somebody makes $6,000 a month, their total debts, including the new house payment, which would include taxes, insurance, any mortgage insurance, any HOA dues if that were a part of it, could only be $3,000.
Okay.
That would create your debt to income ratio.
Okay.
Follow me?
Yes.
Now, different programs and depending on your credit score will allow for different things. Typically, a conventional mortgage, if you have an excellent credit score, can go probably to that 50%. FHA, some other government loans like a VA loan can go higher. I've seen VA loans get qualified at 64%.
Oh, wow. Okay.
So it really depends upon the program, current debts, current credit score.
So I heard you mention credit score. Can you elaborate a little bit on that?
Yes. So credit score is well, first of all, with the credit score, loans are based on risk. Okay. So the lower a credit score, the higher risk you are based on the current debts that you have, on how timely you are paying them back, or if you're paying them back.
Okay.
So the lower the number, the worse your credit is.
Right. And that's really telling the lender that you're not so great at paying your bills on time.
Correct.
And following through with
commitment.
Commitment. There
with
you go.
commitment.
Thank you.
Now, I've seen credit scores as high as 850. So the 850 credit score, how big do you think the risk is on that?
Probably not too much.
Right.
Because that's like on the higher end.
Correct. So the higher the number, the less risk that we're looking at. I would rather loan my own money if I said, Brandy, here's $1,000, but I know your 800 credit score, the odds of me getting my $1,000 are pretty great.
You're
I'll
going
get
to
them
feel
back.
confident in giving me that money.
Knowing that you're a 580, which we can qualify all the way down to a 580 credit score.
Okay.
Me loaning you that, not so sure I'm going to get that grand back, right? So that's a little more risky. So think about a bank or a mortgage bank. That's what they base things on.
Okay.
Same with loan to value. Loan to value is similar to, it's not similar, but I'm going to use the thing loan to value based like debt to income. Don't overthink it. It's literally based on how much loan are you taking on the value of this property. Okay. So the less you put down, the higher the loan to value is, right? Because it's a low loan to the value. Does that make sense?
Yep.
Or I mean, a higher loan. It's because it's a lower down payment. It's a higher loan that you're taking out. So they don't have any skin in the game. We do loans as low as 3% down. I mean, there are some loans that are 0% down, which I could do that through Washington State. 0% down.
And so in those situations, you're looking at that's going to affect your interest rate a little bit, right?
Correct.
So like if it's if you're putting a lower amount down and the loan you're taking out is
greater,
significant, then you're going to have a higher interest rate.
A little bit. And it's all those.
All the different factors.
All the different factors.
One of the factors that can
affect
a factor. Your interest rate.
Loan to value is a factor. Credit score is a factor because those all tell a story of who this person is that's borrowing.
Right.
How high of a risk is that person? So in the olden days, there was only one loan, which we would call a conventional loan. It was required to have 20% down at that time.
Right.
Okay.
Right.
So if somebody puts 20% down, 20% of the equity is already there out of the 100%. That's a lot, as I call it. This term's used a lot. I didn't make this term up, but skin in the game, right?
Right.
They have skin in the game. The odds of them walking away from the money that they put down are very low.
Right.
But somebody that goes into a zero down loan, they haven't put anything into it.
Yeah, they don't have so much skin in the game.
They don't have much skin in the game, right? So they don't have much to risk.
Right.
The more the risk now is on the lender. So that's where you get the risk part of it.
Got it. And that's, again, a similar conversation we have with folks when we have the conversation about earnest money. It is a little bit scary to make a deposit of earnest money at the beginning of a transaction when, anything could happen and am I going to lose that money? And so we often have that same conversation. Like that is showing that you're putting some skin in the game and that you're serious about making this purchase.
In any industry that I've been where there's financial onus, I guess, I don't even know if that's the right term, but I think we're right. I'm making words up now.
I do it all the time.
Okay.
I love it.
So financial onus, right, on everything that ever had to do with commitment was money. That's what it was. So in the terms of with the real estate agent, putting a bigger earnest money down is showing commitment that, yes, in good faith, I want this home that you are selling. That's what you're telling that seller.
Yep.
I'm serious about this.
Yep.
If you come in there with an earnest money check of $100, how serious are you?
Right. Yeah.
Right?
The seller's not going to be too confident that you're going to stick around to the end and actually follow through with this purchase.
Correct. So that's really where you see the commitment on what's going on.
And little caveat there, that earnest money goes towards your closing costs at the end of the transaction. So it's not like you're losing out on that money.
And that's a great point that you just made up because I have that, or that you made. You didn't make it up. But that's a great point that you made because a lot of people ask me that question when we're going through the loan process. Well, I put earnest money down. Where does that go? It is a credit to you as the borrower to go towards your closing costs. And when we say closing costs, if I can go into the closing costs a little bit.
Perfect.
Closing costs, a lot of people use that as a general term. Closing costs. We need down payment and closing costs. I like to explain to every borrower what that means because closing costs is not just closing costs. There are closing costs and there are also what's called prepaids. Prepaid amounts of money that go into escrow. Okay. So that's your prepaid upfront taxes and insurance so that you know that, well, in the state of Washington, taxes are paid every October and in April, every year. So a portion of your monthly payment goes into an escrow account so that those taxes are paid on every 6 months.
So the lender is assured that those taxes
is going to be paid. So part of your closing costs, that people call it, are your prepaids. So when you hear this big amount of $10,000 for closing costs, $10,000 isn't really your closing costs. A majority of that is for the prepaids.
Right.
It's your money. It's your money. Look at it as your money in another account that's going to cover your taxes and insurance.
Right.
Now,
so
if you
it's not
ever
necessarily $10,000 that's just going to the escrow people because they did a job. It's actually going towards your home ownership.
That's correct. And if you ever sell that property or you refinance that property, whatever's in that existing escrow account comes back to you.
Okay.
It's your money.
Okay. That's always good to know.
A lot of people don't realize that. I've had people, clients that I've had for, 15 years that have done refinances with me. They always ask me, we just got a check back for $3,000. What do we do with it? Anything you want. It's your money.
It's your money.
Because what they had to do was reestablish a new escrow account, which was their prepaids.
Okay.
So don't let that get too deep into, I can't do this. It's your money. And I explain to every borrower that.
Okay.
And that's why, for me, I'm probably my biggest fan, but that's why I feel that people really should work with Larry the Lender. I'm going to teach them how their loan program goes together.
Honestly, that's one reason why we work with Larry the Lender, because we are confident that when we pass people on to you, you're going to go through all of those things and answer all of those questions and cover all the things that they need to know. In the past, we have experienced times where one of our clients will, come in after the fact and be really stressed out or worried about one of these topics, and it's like, oh, you mean the lender didn't go over that with you? But with Larry, we never have that.
Yeah, I'm not just going to I'm not going to throw acronyms at them and assume that they know everything.
Thank you.
I think it's important, not especially first-time home buyers, every buyer, because they only do this. They don't do it every day like I do this every day for people.
Right.
So they understand, and I'm going to be the person that's going to pick the phone up after hours or on weekends, so that they don't go into the weekend wondering, well, I guess we'll have to wait till Monday to call them. It's okay. Call me.
Yeah.
Just a sigh of relief that I hear come through the phone or when I speak with them is a win for me, because I know that now they
can relax on the weekend
and
not be so nervous about things. Got it. Let's talk about pre-approvals and why they're so important.
Well, so let's break that pre-approval, that general word pre-approval down.
Yes, please.
I would say a majority of lenders out there really don't do a true pre-approval.
Okay.
So let me explain the difference. You'll hear the word pre-qualification. Okay. So pre-qualification is all based on a borrower completing a loan application. They may or may not have submitted W-2s, pay stubs, important documents to really vet that borrower. It's only as good as what they put in a loan application. They run it through a system called Desktop Underwriter. Desktop Underwriter takes whatever information that they put in that loan application that they did online and says, basically, based on the information that was put in there, they qualify or they don't qualify.
Okay.
That's it. Now, if somebody made a mistake, it could be a big gotcha at the end.
Yeah, and that's common. We don't always know the exact numbers of some of our debts or some of the payments we make or some of the, if you have multiple sources of income, you might not know when you're writing that application the exact amount of income.
I've actually had people on that income portion of the loan application put in what their net income is after taxes are taken out, because they want to be cautious. They know themselves they don't want to be house poor. They want to, right?
Okay,
so they're giving the worst case scenario.
Yep.
We don't qualify on net income. We qualify on gross income.
Okay.
So if they put their net income in there and they don't communicate that properly, and I'm thinking gross income, and now they don't qualify for a home, period?
Yeah.
Because I'm looking at that net income as their gross income.
Right.
That could suck for them.
Right.
It's
because a really great distinction.
So that's very, very important to why I like to do a true pre-approval. Now let's move to that pre-approval process.
What does that look like?
So what I do is I request a number of documents that are important to do a true income calculation. to do time on the job, to do verification of employment, those sorts of things, to make sure that they, number one, that they've worked long enough that they are a qualified person. We take it one step further where we actually get it under the eyes of a true underwriter.
Okay.
They put their stamps in, and every one of those approvals, if it's approved, will come as called a conditional approval.
Okay.
And the condition is based on the property that they find.
Okay.
Because we haven't found a property yet, right?
Right.
So who knows what the real estate taxes are going to be.
You've already done all your due diligence.
On income, employment, all those sorts of things that are important, right? And we verified these things. That's a true approval. Now, let's say I have a borrower that comes to me, does the loan application, and he makes $20,000 a month, has zero debt, and he wants to buy a house for $600,000. I can do an electronic verification of employment through a system called the work number, and I can verify myself. If all those numbers are great and their debt to income is so low, I don't need to do a true TBD approval and waste the time of an underwriter, because I've done my due diligence.
Yes.
We're good, right? But that's the communication that I have with myself and the real estate agent to go get that house. We're going to be good.
Yeah.
Does that make sense?
Yes.
You know what I'm saying?
And
so it's all based on the scenario. Everything's always going to be based on the scenario.
Yeah, everybody's situation is different.
Right. Sure. I go one step further, and this might help other lenders out there. You know, there's business out there that everybody can gather. And if I can teach a lender even something that might help them, some young guy that's coming up, this is one of my secrets I'm giving out. But once I do that due diligence and I know an offer is going to be made on a home, I'll call that listing agent before they call me.
Okay.
And I'll tell them, hey, you're going to get an offer from Mr. and Mrs. Johnson. I want you to know that I have all their documentation, their asset statements, everything, and this is the offer that you would probably want to accept.
Beautiful. I love that communication.
And every listing agent that has gotten a phone call from me has appreciated that phone call.
Yeah, definitely. Yeah.
It takes one thing off of their plate.
Exactly.
Of having to do their due diligence, right? So at the end of the day, we're trying to make everybody happy. The seller is trying to sell a home. The buyer wants to buy that home. So we want that to be successful. The real estate agent also wants to sell that home because that's what their job is to do, to make somebody happy. And I want to make somebody happy in getting their loan approved into a home.
Right. We're
all
in the
same
business
boat
of finding win for all solutions. And when I say that, it's win for all parties.
Yep, everybody, right? And that's how you create relationships and people refer you and whatever. But you know, you want to be a good name. You don't want to, as soon as you make a mistake, everybody says stuff, right? I'm human. I've made mistakes, but I follow my sword too.
We are all human, and that is something I think in business is so important to remember, and so often we forget that. Right. So thank you for bringing that.
Yeah, and so the communication has to come from the borrower too, the buyer and the seller.
Yep.
If we don't get proper communication, that could deter things.
It can change things for sure. Yeah. So one of the things I got out of that, and what I heard, what I'm hearing is when I see somebody bring in documentation that says pre-qualified, that is an opportunity for me to have a deeper conversation with my client and maybe even the lender.
Yep, I would. Yep. If the lender and the real estate agent aren't working together, again, as I mentioned earlier, I'm the guy that picks up the phone. I think William can even attest to this, that he can call me and I'm like right back to him. I think it's important to keep that ball rolling in a positive direction, so that you get to the finish line successfully.
Awesome. Perfect. Okay, so one of the things here is we often hear, and we see it on the internet, right? You go Google, best advice for first-time buyers, and you see the advice of go to several different lenders. Let's talk about that a little bit.
As we all know, knowledge is power, right?
Yes.
I would say be cautious in doing that, but also don't not do that.
Okay.
It's because that sounds kind of weird, right?
Right. It almost sounds like we're contradicting ourselves.
Kind of, but so let's kind of bring that to more of a sharper point. Balance yourself. Do you need to contact 20 different lenders, I wouldn't do it. We all pretty much do the same thing, and we all have to follow guidelines that are out there based on the loan program. FHA has guidelines, USDA has guidelines, VA has guidelines, conventional mortgages, they all have guidelines. Everybody that you would talk to has to follow those guidelines, period. What I would ask for is, if I was a borrower, when I'm talking to people, I would ask for you to think about, what is your gut telling you? If your gut is telling you that this person is going to get you to the finish line with the least amount of stress, that's where you need to go.
Right.
Interest rates are all going to be based on that borrower's credit history, the loan to value, sort of like what we spoke about before, right? And as far as that goes, interest rates are such an ambiguous number because it depends on how the loan is structured. You could buy points down, there are different ways of getting a lower interest rate. It's not all about just what is there today, right? If you get seller concessions, which means, seller helping pay closing costs, that can help buy your rate down. We actually, if somebody on one of your listings does the loan with me, we as the lender will give 1% of their loan amount to go towards closing. So that could be used to buy points down. So there's a benefit of working with a team of people like that, like what we can do together, that will benefit the borrower.
And so what I'm hearing is you kind of want to interview a couple, maybe 2 or 3.
I would not let them pull your credit.
Without pulling the credit. But just interviewing them to get a feel of what it's going to be like to work with that person. And if you feel confident that you're going to be able to get through a very important transaction, this is a very important decision that you're making and purchase that you're making. So if you, in your gut, feel like, okay, this is the person I want to work with, then definitely, go with them. And it feels like they're doing their due diligence and they're going to be, communicative to the level that you feel comfortable with.
Well, remember, as a borrower, the real estate agent and the lender that you choose really now are working for you. And I refer to that when they ask me questions. I tell them, I'm working for you. Like, you're the boss, really. Right? I'm advising you through this process. But to go back to what I was saying about pulling credit, don't have 4 or 5 different people that you might be talking to, which I hope it's not even that much, honestly. You know what? Talk to a couple people and go with your gut.
I'm thinking like 2 or 3 is a good number. And also being educated, if you come in and they're pushing you to pull your credit, then you know that might be a red flag. Because
here's the reason why they want you to pull your credit, because they want you to commit to them. But get your gut feeling first. I'm going to go the opposite of what, of course I would like to be able to pull somebody's credit. But if I know they're talking to 2 or 3 different people, I'll tell them, you know what, before I pull your credit, I'd rather have you determine if you want to utilize me or not. Because every hard credit pull could affect their credit score. Now, you have the ability to shop like for 30 days. I forget if that's the exact number, but where it won't affect you. So you can do that, but it just doesn't really look good. Now you have credit inquiries on your credit report. That's just my personal opinion. So when you're looking at that lender too, even though you've made that determination, right? You've got a great gut feel. I think it's important to also find out what are you paying for that service. That's also called origination. So you hear this term origination fee. That's what the lender's charging you. So there may be lenders out there that they all do it a little differently. Some people say we don't have an origination fee, but we have a processing fee. Some people say, well, we have a processing fee and an underwriting fee, but we don't charge origination. Those are all origination fees.
They're all basically charging you for the services that
they're providing. That's correct. And so nobody's doing loans for free.
So if you see, for example, somebody saying no origination fee as like their promotional piece, double check that there isn't an underwriting fee or a processing fee or something along those lines. So
you can request what's called a loan estimate. And that will break everything down for you. Now, there are some places, which I can't believe so happens, but there are some people, you might have the best gut feeling with this person, but the company that he works for charges a 1% origination fee. Okay. So that's going to be 1% of whatever your loan amount is. So let's say your loan amount is, you're borrowing $500,000. Okay. Your origination fee for that is $5,000.
Yeah.
Okay. Right now, at the time that this is being recorded, we don't do a 1% origination fee at my company, at least.
Okay.
We have a flat fee. We're a flat fee company.
Okay.
All we charge is $1,795, $1,795, and it's a flat fee. So if someone buying $1 million property, that's it, right? So let's say someone's buying $1 million property, and that's a difference.
That's a big difference.
Now, if they still want to spend that amount of money, they can use the difference and buy the rate down.
Okay, yeah.
Right?
Yeah.
So anybody that's charging that amount, they're going to show a lower rate, but you're not paying, everything's being paid for somehow. You're either paying for it up front or you're paying for it in rate. Nobody's doing those things for free for you. Don't be fooled. If somebody's telling you that, take your bat and ball and go play ball someplace else.
Gotcha.
I think it's really important. So when it comes really to who you're going to choose, at the end of the day, a borrower needs to figure out who they feel comfortable with, who are they connecting with, because this is going to be probably the biggest purchase that they've ever made.
Right.
So when it comes to all of their secured documents, private information, income, banking, who do you connect with? Who do you trust?
Who do you trust?
That's really what it comes down to. Me personally, this is going to sound really weird. I don't want to work with somebody that doesn't feel like they trust me, because the experience is not going to be good for them. No matter what I do, it's not going to be good for them. I want to be connected with them because I want to be their mortgage lender for life, because someday they might have to refinance. They might have a kid. They might have a brother, a sister. I want to give them the same service that they receive. And if they're not connected with me, then it's not going to be a good service in their eyes.
So speaking of working with lenders and making those decisions, what's the difference with working with like a bigger financial institution versus a mortgage broker?
So a lot of that really has to do with programs that are out there. So think of a broker as somebody that takes your package of your loan package and thinks, let's place it over here to get an approval, or let's place it over here to get an approval, or here. They're brokering. That's called brokering out that package. Okay. Your bigger banks, brick and mortar, we'll call them. They have their own programs. A lot of times they want to keep it in-house because they want to be able to do checking accounts, savings accounts, etc.
They're trying to get you to do more services.
Yeah, so a lot of times the mortgage part of that is a value add, because really they're designed as a depository lender to do checking, savings, credit cards. Oh, and by the way, if you have your banking with us, we can help you with your mortgage. And a lot of people think they need to go to that specific bank.
Yeah.
Now, there are mortgage banks that don't do credit cards, deposits, that sort of thing. They just do mortgages, and that's what their main business model is. Okay. And that's fine too. Then there's a guy like me, which we're driven by a big bank, but we're a mortgage arm of that big bank. So now in our area, we do mortgages really well, but we have the option now of doing portfolio loans within our bank. So we have a bigger blanket that we can cover, a bigger net that we can cast to have a product for somebody. So they have more options, I guess. Does that make sense what I'm saying? So it really depends. It's all going to go back to the previous conversation. Who do you feel comfortable with?
Yes.
Who do you connect with?
Right.
Because it doesn't matter the motor that's driving it. What matters is the gas pedal that's being pushed down, if it's being pushed down properly to get you to your destination. And that's to become the homeowner.
And would it be fair to say that for some folks, depending on their specific financial situation, that it may benefit them to go to maybe somebody like you where you've got more options for folks, or to a mortgage broker versus their bank that they've been banking with. Their, what did you call it? Depository.
A depository lender.
Yeah.
No, because they're all driven by guidelines anyway.
Okay.
They all have to fall into the same. They're all looking at the same guideline. There's still rules to getting the mortgage done.
Okay.
Now, a bank might have a special program where they portfolio. That's when I say portfolio. They keep that. It's never sold to Fannie or Freddie.
Okay.
So that's a
they
keep that in their own portfolio.
And that also is a big conversation that we could definitely talk on for a while in another video.
Right. So, and they have their own guidelines, their own bank-specific guidelines.
Okay. Would you say there's any benefits or drawbacks to working with, say, a big brick and mortar bank?
Yeah, so think of the big brick and mortar bank as a big ship, right? They're not very quick and nimble. You've heard bankers' hours, whatever it may be. They're probably a little tighter on guidelines. They may not be able to go to a 580 credit score like a guy like me. Okay. Right?
That's where I was trying to get to there. Yes. Perfect.
Now, somebody that can do that, think of them as the little bayliner boat that can get in and out of wakes quickly. They can move quickly and they can make things happen faster. They have better maybe communication with their underwriting department. Like me specifically, I could pick a phone up and call my underwriter.
Okay.
Right? There are a lot of companies that do not allow you to do that.
And Larry the Lender is available way more hours than
exactly
the neighborhood bank down the road.
Correct.
All right, so now I want to talk about what are some of the spending decisions folks make that hinder their ability to get financing, or let me also clarify that, or that might make the transaction experience not as easy as it could be.
So my advice to that, number one, I'm going to call it my advice to this, is people go rogue sometimes.
Yeah.
If you are going to buy a home and you make a loan application and you've chosen that lender, right? You've gone through all your due diligence and you've chosen that lender, Larry the Lender, then don't take anything out on credit. Don't have anybody pull your credit report. Don't go buy some item on time with installments. All those things that you did, you just increased your debts.
Right.
Now remember, your loan
affect your debt to loan
debt to income, right?
And it could affect your credit score.
Well, not only that, but it could disqualify you, because if the debt to income ratio goes over the qualifying number, then you no longer qualify for that home loan.
Right.
But you've got a nice new Lexus. Right. That would suck.
Yeah.
Right?
So I have a question. So even then, when you talk about that, what about with your bank account? So I know a lot of times they ask for bank statement. So what about you go make a big purchase, you did take out on credit, but you spent $2,000-$3,000. That's going to show on a bank statement later on. Will that affect?
Only if it goes under what those assets that you need to, what's called funds to close. If it's going to take you if you have $50,000 in the bank and you need $30,000 for your funds to close, for your down payment,
don't go spend $25,000.
Don't go spend 25, because that puts you under your funds to close.
Right.
So as long as you still have the assets to close, who cares what you do?
I just had another thought too. Earlier, when we were talking about the underwriting process and you look at employment, can you talk a little bit about the requirements for employment in order to be approved for financing?
So generally speaking, you need to have 2 years of employment in the same field.
Okay.
Now, that's why I say generally speaking, because you might have somebody, let's say Jenny, I'm just coming up with a name. Jenny's been in college for the last 6 years to be a veterinarian. Okay. And she gets a job offer. She's working at Edgewood Vet Clinic. Okay. They're guaranteed, or her salary is going to be $70,000 a year. And she started 2 months ago. If she's going into a field, but she's been studying, that college experience can be considered as job experience.
Okay, that makes sense.
So it's all scenario driven, right? It's all specific to each person.
Right.
So let's say somebody is going from a W-2 wage earner, right? They get paid an hourly rate or a salary or whatever.
Yep.
And now they're going to go sell cars.
Yeah.
And their income's based on commission only.
Yeah.
Not going to work, because it's got to be based on 2 years of commission.
So you're saying that if you're going to become a business owner or be based on commission, those kind of scenarios, that you need 2 full years.
2 years. Because they're taking an average, a
Okay.
2-year average.
And so is there any scenario where somebody might get approved for financing with only 1 year of experience in a specific field?
Yes. So Freddie Mac's guidelines are 1 year of.
Okay.
So depending on, that's why you need to have an experienced lender, because I would say 80% probably loans get sold to Fannie Mae. They get run through what's called desktop underwriter, not loan prospector.
Okay.
So I run it with both findings on the underwriting part. If I choose, if we're not there, then I have a different road to go down, that they've been only 13 months on the job, 15 months on the job. We don't need to necessarily wait till they get to 24 months on the job.
So for folks who only have a year under their belt in whatever industry, there are still options out there for you.
And we have to just run that through to make sure that we get an approval.
Okay. And the other point too that I'm hearing is, if you're looking to buy a home in the next year, then you really want to make sure that you're checking in with your lender before you make any kind of employment change decisions.
100% correct.
Okay.
100% correct.
Awesome. The advice I was looking for and the clarity that I was looking for.
Don't make think of it this way, don't make any crazy moves without talking to your lender first.
Yes.
And if I could really throw this out there, if someone's planning on buying a home, don't just wake up tomorrow morning and say, let's go put an offer on this house.
Right.
This is a big purchase, right? So do yourself your own family's due diligence or your own due diligence. Go through a true pre-approval process. See what that means. And if maybe you don't qualify for a home today, let's figure out what it takes to get you to qualify for a home tomorrow.
Yeah, I think that's a really good point to make as well. If you're even considering buying a home anytime soon, it's a really good idea to go ahead and do those interviews with lenders and figure out who you want to work with and start the process as early as possible.
Well, I think a lot of people go to you all as a real estate agent first because you're the sexier side. No one wants
the fun side.
You are, because people want to look at homes. They see this yard arm out there that says new listing or whatever it may be. It's like, man, that's really pretty, because whoever listed that home had these people really make it look nice and pretty as a sellable product.
True.
No one says, I want to go shop for a mortgage. That just doesn't sound good.
No, and I guess you're right.
They should actually come to us first so that we can find out what they qualify for, so that we could send it out to you as a real estate agent to say, we need to stay within these parameters so they can see what they qualify for, instead of going and looking at the $1 million home and then finding out they only qualify for $700,000.
And then
that's
you're
a heartbreak.
Getting your hopes up, and then you're getting disappointed.
Yeah.
And thank you for saying that, actually, because a lot of, majority of people are going to go to your agent first or find an agent first because you're wanting to go get out there and look at those homes. And a good agent is going to have that conversation with you from the beginning. Are you pre-approved? Are you working with a lender? Do you need some recommendations or referrals for a lender to get you going on the right foot? So I wanted to circle back around. We went over it a little bit in an earlier topic, but it's all over the news and it's what everybody's talking about, and that's interest rates.
So you're right. Everybody, that seems like that's what they want to hang their hat on. Every single loan, the interest rate.
And we get that question all the time. What are the interest rates like right now? Do you think they're going to go down?
So number one, that first part of your question, you said, I get all the time. What are interest rates right now? Or I hear somebody else say, well, interest rates are X.
Yeah.
It drives me crazy. That's the worst question that somebody can ask, because what are you basing that on? Every loan program has different rates. Are you basing it on a FHA program? Are you looking at a conventional? You didn't say what that was. What are you basing it on? Are you basing it on his credit, her credit? She doesn't have very good credit score. He's got a great credit score. Are you basing it on his 25% down? Or are you basing it on her 3% down?
Right.
As we mentioned earlier, loans are based on risk, right? So an interest rate is also part of the risk. So that's where it goes up or down. High risk, you're going to have a higher interest rate.
Okay.
If you're a lower risk borrower, you're going to have a lower interest rate.
Yeah.
That's just the way it is, right? It's not the guy that's doing the loan application that determines that. It's your personal credit history that determines that.
Is it also affected by how much you're borrowing compared to how much the value of the property
That's
is?
the loan to value, yeah. So that does affect, it can be affected by that. Here's what people need to think about. And I've heard this term too before. Marry the house, date the rate. Stop saying that. Stop saying that. I'm hearing it on car ads now too.
Oh, that's funny.
Marry the rig, date the rate. What is that?
What does that even mean?
I know what you're trying to say, but really what it comes down to is don't discount or don't penalize yourself of not getting that home because of an interest rate.
Right.
If that's the home, remember you're going to live there. That's the place that's going to make you happy. If you want to become a homeowner and the rate is what the rate is for you and it fits into your budget, then you need to move to that home if you qualify. Seeing rates in the 2% like they were before, we may never see that again.
Right.
And you want to know something? Whatever rates are right now, we may not even see this again. They can go up tomorrow and the next day, and you're going to wish that you would have taken that lower rate. Today is the lowest rate that you're going to get. Today is the lowest rate that you're going to get, period. Now, if you do that, get that rate today, and you get into your home and you close on whatever that rate is that you qualify for today, I can almost guarantee that that loan that you are currently in will not be your final loan on that house. So don't be so hung up on what that is. Be more hung up on, is this going to make you house poor? Like what we talked about earlier.
Right.
Does this fit into your budget?
Does this home make me happy?
Does this check all the boxes? That's what you need to look at. Because will rates go down? Maybe. Will rates go up? Probably. That's really where you need to think. Because again, let me rephrase that. If rates go down, you can refinance.
Yeah.
And you can get a lower rate. And we also talked about this earlier in the video. Real estate taxes go up, right?
Right.
So there's going to come a time where maybe you bought this home and you were maybe more of a credit risk. Maybe that's why you have such a higher rate than most people. Your credit score is also going to improve because you have a mortgage. Make those timely payments. Start getting on the right track. So do you think you're going to qualify for a lower rate later? Yeah. That's why you're not going to stay in that loan for the rest of your life.
Yeah.
So that's why I really deter people from being hung up on penalizing themselves because they think a rate's too high right now.
Awesome.
It doesn't make sense.
Really helpful way to break that down. I think that you touched on a few things that people don't always think about.
Yeah.
Definitely.
Yeah.
Understanding these costs up front can prevent financial surprises and help you budget effectively. Thank you, Larry, for coming today and sharing your wealth of knowledge and having this conversation. This was an amazing chat. I really enjoyed this. And thank you all for watching. If you found this information helpful, please give us a thumbs up and subscribe to our channel for more Western Washington insights. If you have any questions or want to learn more about being prepared as a buyer or financing, leave a comment below or reach out to us directly. All of our information is in the description box below. Until next time, explore, dream, and discover the best places to call home.